I'm Jerry Horak, and I'm on the City Council, the Mayor Pro Tem. And the meeting tonight, just to tell you the purpose, then I'll go over who's up here and what the format's going to be, and some other logistics. But the main purpose of tonight's meeting is really an informational meeting. It's about questions and answers. This isn't a meeting about opinions. So the opinion night is May 6th. For those who have opinions on the mall, besides there's emails you can send to council members, whoever you would like about it, but we're trying to get more of the information out. Because what happens at council meetings lots of times is there are many people want to speak and they only have a limited amount of time and they have questions. And then we as a council or the staff doesn't really have the time to answer the questions then because we're dealing with our questions. So tonight is a chance to get that information out, get your questions in. We'll have a presentation by Mr. Mike Beckstead, who's the CFO for the city, it's Chief Financial Officer. Darren Atterbury will have a few comments. He's the city manager. Don Provost is the developer, and some other meetings he hasn't been able to attend. And I know people sometimes have some questions about why something has happened the way it is at the mall or some of the financing or whatever. So Don's here to try to address those. We'll have some folks taking some notes especially if there are questions or issues that we haven't addressed or aren't able to answer, to make sure we do that. Whatever questions you ask tonight, if it's not one of the ones we've already answered in the FAQs, which hopefully everyone has a copy of, we'll make sure we note that and get answers out to everyone. And these FAQs are being posted on the website, so it's available. If additional questions come in, I'm sure there's a way to do that so we can get additional answers up. So really the whole purpose is simply to get the information we know about this out to you and get your concerns, questions about things we need to answer, provide more information to the council and to the community. So come Tuesday, May 6th, the council can be informed, you can be informed, and we can make a decision on this particular transaction. So the format basically is Mike Beckstead, who's the Chief Financial Officer and has been really involved in these negotiations and has done a number of presentations to the council and the community on this. We'll have a short slide presentation. It's really just to give you some of that information that's in the handouts and have you understand it better. But before he speaks, Darren Atterbury is going to just say a few things because he's been involved in this with the mall since he's been at Fort Collins and actively involved over the last 10 or 11 years to give people some historical perspective, because some of the comments sometimes, why don't you just wait? I'm sure somebody will do this. He can give an ideas of what's happened there and what has been the timeline on this particular series of events that started back nearly 2 years ago. And then Don's available. It's not so much he's going to give on the presentation, but he's available to answer questions that you would have about the mall, about his part in these particular transactions. My job is to facilitate the meeting. And in doing that, we're asking people, instead of raising your hands and giving short speeches and then maybe asking a question, that you put your questions down on note cards and drop them up here, or actually Emily and others will be walking up and down the aisles that you can go give it to them and they'll do it. And it's not trying to shut down anybody, but again, it's trying to focus on information and not giving some people who just keep talking more time versus those who just ask direct questions. Again, it's an informational one. So with that, well, actually, any questions about anything I said? Good, that's unusual, actually. Mr. Atterbury, Darren will give a short perspective, a historical perspective of where we are currently.
Thank you, I appreciate it. And Pat, can you hear me back there? Okay, so thanks everyone for coming. We really appreciate it. Obviously, this is a very important issue. It's getting a significant amount of discussion and debate in the community. And as Mayor Pro Tem Horak suggested, what I want to do is just give a little bit of history, and then I think just as importantly, why we're making a recommendation to the council that they approve this agreement as proposed. So let me just say, little over 10 years ago, I was appointed as the city manager, as the interim city manager, and about 9.5 years ago, I was appointed as the city manager. From day one, and Mayor Martinez is in the room, former Mayor Martinez, and he knows it as well. He was on that council that hired me. From day one, the #1 economic development project for this city was the Foothills Mall. We've done a lot of things between then and now, but I can tell you from day one, that was a very, very important priority. And here we are 10 years into it. It continues to remain as a priority. During that 10 years, I've had the privilege of working with 3 owners of the mall, of Foothills Mall, the Everett family, General Growth Properties, and now Alberta and Don Provost and his colleagues. We've had Also, when General Growth Properties owned the property, we had multiple iterations of development proposals. And then also we had several other parties who were contemplating purchasing the mall from General Growth Properties. And we talked about a number of different designs, and none of those came to fruition. This is really the furthest that any redevelopment project at the Foothills Mall, furthest that any project has come. And I'm going to talk a little bit about some of the challenges just very quickly. So what has been the priority since day one? And I'll share with you a little bit about what council's priorities have been, and then what, as a city manager, what my priorities have been. And they've been completely in sync, and that's to get the site redeveloped. But I will tell you that a lot of people come up to me oftentimes and say, well, this is going to be a lot of money to the city of Fort Collins. And a lot of money to your local government means we can continue to provide quality services. Without revenue for the city, we can't continue to provide higher quality services. So that is important. But I will tell you, as a planner, for me, number one has really been to help build a sense of place on that site. It's a 77-acre site. We all know that it's blighted at this point. So number one really was to help build a sense of place in that area, a place that we're all proud of. And as I've shared with council members time and time again, as I'm out in the community, whether I'm in my neighborhood, whether I'm at the city, whether I'm at church, whether I'm at a Home Depot, folks come up to me and say, what are you doing about the mall? Do something about the mall. And they've said that for the last 10 years that I've been in this position. Number two is this idea of, with its significant investment in the Foothills property, will that be a catalyst for other Midtown area improvements? And we absolutely believe the answer is yes. It will have this improvement, this redevelopment will have a positive impact on the redevelopment of the Midtown corridor. And then also, and thirdly for me, maybe not for all elected officials that I've worked with, is this idea of bringing revenue to the city. And again, the additional revenue that Mike will talk about will enable us to continue to provide the quality services that everyone has come to enjoy. Throughout this entire process, one of the main things that Mike and I and other finance directors that preceded Mike was, when you're working on this site, be cognizant of the financial risk to the city. Do not put the city in a significant risk position. So what you'll hopefully hear through the questions is that there have been many, many other retail developments proposed and agreed upon in Colorado that cities have taken on, city and counties have taken on a much greater risk position, but have also seen significantly increased profits from that, or revenue flow. We have taken a very low risk position for the city, and I think you'll hear that. Hopefully you'll hear that later today, or later this evening. A couple other things that we heard was resolve the Sears issue without using condemnation. I mean, that seems like that was years ago. We have resolved this issue. We've not used eminent domain. We did, in fact, threaten that a few years ago, and with the help of Alberta and Sears, and I think some pushing from the city, we are not utilizing that tool in this agreement. We also heard from council and the community, facilitate the ARC thrift store movement. Do not condemn them, and make sure that we address those issues. So we have done that as well. Help build a new, more progressive youth activity center. That's in this proposal. Help build a tunnel under College Avenue to help facilitate movements from the Max line to the mall. That's included. Build housing on the site, put storefronts along College Avenue, build a streetscape, this real sense of place that we're talking about. And so I will end with this. After having spent on this proposal, not over the last 10 years of proposals, but in this proposal with Alberta, and having spent over 7,000 hours of staff time and hundreds of thousands of dollars, my recommendation and our chief financial officer's recommendation to the city council is to move forward with this proposal. And so what this is this will be version 3. And Mike will talk about this in detail. You'll recall we had the first proposal came forward. There was a unanimous yes vote on that. Mayor Wycannot conflicted out of that conversation. We had a second vote. Don is prepared to talk about the amendment to the contract that he had requested. At the same time, we requested of council that they make some further amendments that improve the position for the city. And then a couple of months ago, Alberta came to us and said we would like to ask for an amendment to this contract. So this is the third time next Tuesday night that the city council will hear this proposal. So with that, that's the context, and I'll turn it over to Mike Beckstead. Mike, you want this or
I'm not really a guy who likes to stand behind the podium, but I think they're taping this, so I'm going to try my best. I'm going to go through this fairly quickly. I could probably spend a good hour and a half talking to you about the next 12 slides. I'm going to try my best not to do that, because I think I'll put you all to sleep. So I'm going to hit the high points, talk about the high points, and then when we get to the end, we'll kind of go back to questions. Darren has really talked about this slide, what were we trying to do and what were the challenges, and I think he's really gone over this. To put it in graphic, in a picture form, this slide reflects net taxable sales coming off the mall project. Going back to 1990 through 2013, we peaked in 2000. And you can see we've been on a fairly steady decline ever since. We're probably down 55, 60% from that high point. That's the mall that's in decline. So the question in front of council a week from tomorrow is a modification to the agreement. But I want to spend 3 or 4 slides just telling you about the details of the financial agreement, because I think it's important context for all citizens to get and understand that. So the first point I want you to grab is you've heard about $53 million of city public money going into this project. I want to tell you where that 53 goes, and then I'll tell you where it comes from. But it's 53 of what we call public improvements. I would break those public improvements into 2 groups. One is blight removal and infrastructure. And this has to do with blight removal on an existing site. It costs more than a greenfield site. So the asbestos abatement and the deconstruction, the ditch relocation, the site work that has to be done, all of those statutorily are eligible public expenditures for blight remediation inside of a URA. Plus there's $8 million of what we call city infrastructure enhancements. And these are benefits to the city. One is the underpass on College Avenue at $3 million where the ditch used to go underneath, and the other is a brand new, roughly 24,000 square foot activity center that will be built adjacent to the mall. So that's where the $53 million goes. So the next question is, where do we get that $53 million? I heard some comments earlier about putting city money into this, and I think there's a really important distinction here. The first thing is, Darren said, the city is not going out and borrowing money for the $53 million. We made a conscious choice to not put this on the city's balance sheet because we wanted to not take that risk. We could have had a higher return if we took that risk. We consciously elected to have a lower return by having these bonds issued by the Metro District. The Metro District is a quasi-government agency formed at the direction of council. It has a service plan, and the directors of the Metro District can only operate inside of the boundaries established by that service plan. So that defines what they can do. So the intent here is for the Metro District to issue bonds at about $72 million at par, so a $72 million bond offering to the market. Out of that $72 million, we have some capitalized interest because we borrow now and the revenue doesn't start to flow for 2 years, so we're accruing interest along the way. We have a reserve fund that we have to establish per the bond documents, and there's some transaction costs. So out of a $72 million bond offering, that's how we net the $53 million that pays for those $53 million. That's where the funding comes from. Now, how do we pay that back is the second question. The Metro District is going to assess themselves 50 mils of additional property tax. So the owners of the mall, Alberta and company, whatever their current property tax bill, it's going to go up by 50 mils. We anticipate over 25 years that'll generate about $43 million. We'll capture that money and we'll use that to pay the bonds back. Second is the URA property tax increment. After Alberta invests $313 million in the property, they're going to pay more property tax than is coming off of that property today. That's the increment that we talk about. We're going to capture that increment. All of the existing taxing entities will get the current property tax revenue coming off, but that increment, that new tax based on the investment, is what we call this tax increment. That's $42 million. In addition to that, Alberta is going to put a 1% public improvement fee on the transactions that happen at the mall, so that every purchase at the mall pays an additional 1%. Now that's used around the community quite a bit. If you go down to Front Range Village, you're going to pay a 0.65 to a 0.75 depending on the store you shop in. If you go out to Centerra, it's a 1% to a 1.25%. I can't remember exactly what it is, but it's 1% or slightly better. So that's fairly common around here. So the mall shoppers are going to add $65 million. So really, property tax paid by the owner of the mall and the 1% PIF paid by the shoppers of the mall are going to generate these three numbers, which covers 94% of the bond repayment on the $72 million. The delta here is about $9 million, where the city will contribute $9 million of sales tax coming off the mall to close that final $9 million. So really 94% is covered by the developer or shoppers, and about 6% comes from sales tax that come right off the mall. Not out of current revenues, but new revenues coming out of the mall. So that's where the money comes from to pay the 53, and that's how that 53 is paid back. This slide, I want to give you just a rough idea of what this means to the city. We anticipate about $255 million of sales tax from the mall. And I break that down into different pieces because it's really important. This first $3 million, or 3.1, is what we call base. That's what we used to get off the mall. The city always gets that first. There's a piece that's transfer. Sometimes we use the word cannibalization, where people who were shopping at a shoe store not in the mall might now shop at a shoe store in the mall. That's transfer sales. And so there's a bit of that. And then there's this green and the red, which is new, and that $9 million that we're talking about. So the net new in all of this is the 9 and the 117, or $126 million of new sales tax revenue the city is not receiving at all today that'll come off of this project. We'll put 9 back into it, and the city will have $117 million of new sales tax revenue as a result of the mall. So that's the way the numbers work. This number, when you get out to about 2018, is about $4.2 million. The first couple of years, we have to put money in. This $9 million that we're putting into the repayment of the bonds comes out first, but once the Metro District and those other 3 revenue sources can pay the entire bond amount, the city retains this new sales tax revenue. It starts out about $4.2 million here, and when you get out here, it's about $7 million a year of new revenue. And as Darren said, that's pretty significant to the city providing services to the citizens of Fort Collins. So the request on the table right now are 3 changes. One is to adjust the leasing requirement prior to the authorization of the bond issuance, and I'll talk about that in a little more detail. 2 is some clarification concerning some fees the developer would pay the city if the residential component is not built on time. And the last one is some clarification on which of 2 reserve accounts gets used first. So those are the 3 changes. All has been approved, agreement has been approved, agreement has been signed. There's 3 proposed changes to that agreement, and this recaps them. So let me start with the adjustment of the lease. There's 7 conditions that the developer has to satisfy before the city will authorize the developer and D.A. Davidson and the Metro District to move forward with the bond issuance. The developer, Don, is prepared to meet all of these except for this one. 240,000 square feet of executed leases is what's currently in the agreement, with 120,000 of that being tenants new to Fort Collins. And for a multitude of factors that Jerry talked about, timing of when the agreement happened, the way retailers are working, a number of factors, hitting 240 prior to issuing the bonds, but issuing the bonds in time to start construction to have the thing up for the October 2015 holiday season is the challenge that we're faced right now. We could wait until September to issue these bonds after Don's got 240,000 square feet. That's one alternative. Problem with that alternative is we won't have them all probably in holiday of 2015. So that's our challenge. So the alternative that we came up with is really reflected in this slide. And I'll share with you, had we thought about this when we were doing the agreement on January 14th, I actually think this is a better structure than what's in the current agreement. Again, what's in the current agreement is Don needs 240,000 square feet of executed leases, with 120 of that being new tenants to Fort Collins. Once he does that, he gets access to the $53 million of bond proceeds. Again, 8 of that goes to that city improvements. So that's the current agreement. What we're proposing is for approval of the bonds to happen with 155,000 of executed leases, with 90 of that being new tenants to Fort Collins. That's the first change. The second change is, instead of Alberta having access to all 53, now they only have access to 23. And 3 of that 23 we assign to the underpass, so it can only be spent on the underpass. And then the developer has to grow his executed leases in 3 tranches, 205, 255, and 310, with a corresponding increase in new tenants to Fort Collins with each of these tranches, to have a release of $10 million of funds that are sitting in escrow off of that bond offering. So we launch 72 million of bonds, we get $53 million, 23 is available to the developer, 30 goes in escrow, and as they hit more leases, they get it in $10 million increments. So that's the adjustment as it relates to the lease. From a performance perspective, it's 129% greater than the original, and it ends up with 60% of the project, excluding Macy's, being leased before the developer has access to all 53 million, versus 47% before. So it really raises the standard of how much leasing activity has to be in place before all 53 million is available to the developer. So what are the risks and what are the implications? As I mentioned earlier, these bonds are not issued by the city. These bonds are issued by the Metro District. That's a conscious, deliberate choice, and it's done to protect the city's credit rating, balance sheet, revenue stream, all kinds of reasons. So from a city perspective, and when you think about risk depends on who you're talking to and who you're talking about. So first group I want to talk about is the city. Well, there's no change in the financial risk to the city, because the city is not obligated financially in any way, shape, or form to make payments on these bonds. So no change is the financial risk to the city. One benefit to the city is it avoids the interest rate risk associated with the bond issuance in late 2014. We're in a rising interest rate environment. I mean, and we have been saying that now for 6 to 12 months. I think it's starting to manifest itself. How it accelerates, what it looks like in 6 months, I don't know. But there is some comfort, so to speak, or some risk avoidance in issuing the bonds now and locking in a 6 3/4 to 7% interest rate on these bonds, versus waiting 6 months and then having whatever interest rate is available 6 months from now, because it could be higher. It could be the same, but it's an avoidance of a potential risk. To the developer, there's no benefit to the developer of any of these changes. It simply allows the developer to keep his construction timeline, keep his leases intact, and continue on towards an October of 2015 grand opening. To the Metro District, there is a little bit of risk to the Metro District, and that risk I call startup risk. Startup risk meaning we issue the bonds.
Excuse me, Mike, why don't you explain what a Metro District is?
Okay. Metro District is a quasi-government agency. It's established by council. Council reviews and adopts what's called a service plan. And the service plan gives power to the Metro District that's established. The board of directors of the Metro District are the property owners in the Metro District. In this case, it's going to be Alberta and Macy's are going to be the various directors of the Metro District. And the powers and the authority of what that Metro District can do are all defined inside of the service plan. That service plan was reviewed and approved by council back in May of 2013. And that one of the things that Metro District can do is raise financing. And there's some limits and there's some caps on how much that financing can be, but that's again something that's spelled out in that service plan. So the Metro District, when it issues those bonds, really after 240,000 square feet, that was kind of a cliff event in the old structure. They got to 240, they could issue the leases, they had access to all $53 million. Now they issue at 155. And really between 155 and 240, there is theoretical risk in there. I would agree with that. If something catastrophic happened in the nation or in the globe that would cause us prior to 240 to have backed off of that deal, this deal, that's the potential risk. Now that would have to be a really catastrophic kind of event for us to back off. If I go back to September, October of 2008 when the Great Recession started, it was probably Q1 of 2009 before we really had a sense of how severe of a contraction we were into. So even that kind of an event, I'm not sure would be significant enough for us to back off if something like that started in the next 3 to 4 months. So it'd really have to be catastrophic. But it's really, if something happened in this 155 to 240, that's really the only difference. It's a very low probability event, and it would be something that would have to happen between now and the developer achieving 240,000 square feet. So I don't think it's a significant risk. So going on to change 2. Change 2 has to do with a 50% payment associated with the lost property tax revenue. Going back to where the funds are going to come from to pay the bonds down. I talked about the URA property tax increment. Included in that is the property tax increment that's coming off of the 446 residential units that Alberta is going to build. Those units are planned for 200 in 2016 and 246 in 2018. If they don't build those units to that time frame, there'll be less revenue coming into the Metro District because that property tax increment won't be there. We were sensitive to that, and so we built into the agreement that if they don't build those units to plan starting in 2020, Alberta will pay the city 50% of that lost property tax revenue. That was designed to protect the city's interest because we've got this sales tax pledge out there, and if there's a shortfall in revenue in the Metro District, we have to use our sales tax to back up that shortfall. So if they don't perform on the residential units, that will create a shortfall. And so we built into the agreement that the developer is required, if they miss those delivery dates, to pay 50% of that lost property tax revenue. The way the Metro District's Bond Council is reviewing the language in the agreement, it appears to them as if they miss the dates, and they have to start paying the 50%, and then they build, and they start paying property tax because they complete the units, they'll have to pay both. That was never our intent. The intent was to have the 50% payment go on until the units are developed, and once property tax begins to flow from the units, the 50% goes away. So that's all this is. It's a clarification based on a legal review of the redevelopment agreement so that they can get a clear opinion from the legal counsel as they issue these bonds. And that's really the clarification. The third change also came out of a legal review. To enhance the credit on these bonds, bonds typically have a reserve. And the way this reserve works is, again, that $72 million that's issued. Out of the proceeds of that, we're going to set up a reserve account. And it comes from the funds of the proceeds. To enhance the creditworthiness of those bonds, we also agreed to set up a supplemental reserve. And that's going to come from sales tax and Metro District revenue that comes off of the project. And so those are two separate reserves. They'll end up being $14 million of reserves associated with $72 million issuance. And the question gets to, if you need to use a reserve, which do you use first? We structured the agreement that we use the reserve first and not the supplemental reserve. We got it backwards. I probably own this one. I was thinking about trying to protect the city because we get this supplemental reserve back at the end of the deal. And so I'm probably the one who even initiated some of this conversation about let's use the reserve before we use the supplemental so that we can get that back at the end of the year. Well, we didn't think it all the way through in candid feedback. Two reasons why that is not appropriate. If you use the reserve first, those bonds go into default because the bond documents specify you have to have a 10% reserve sitting out there. As soon as you tap into that 10% reserve, you're in default on those bonds. And there's all kinds of regulatory filings that have to happen because of that. We put the supplemental reserve in to be an enhancement. So using the reserve before the supplemental negates the reason why we have a supplemental reserve in the first place. Second thing we thought about as we kind of worked through this when the attorneys brought it to our attention is if either reserve gets drawn down, we have to refill it with available revenue. And right now, because we're using virtually all of the revenue coming off the Metro District, if one of those reserves got used, the refill is most likely going to come out of sales tax. If it comes out of a sales tax, it really doesn't matter which bucket we put it in. We have to put it in either bucket. And so in that sense, it's neutral to the city in the event there's a need to dip into either one of those reserves. Now, I will share with you, just as an aside, our financial forecasts on the mall are really conservative. We're using $375 a square foot in sales coming off the mall on average. Things like the theater are 150, other stores are 500, but the average is 375. The average mall in the United States, sales per square foot is about 450. Flatiron is 620. Cherry Creek is 730. I think we're pretty conservative in our 375 forecast. And if you go back to that slide where I showed the net new sales tax flowing to the city, where we have $4 million of new sales tax a year, this mall would really have to crater to have to dip into those reserves. Kind of my opinion. So the probability of having to dip into the reserves is, I think, another fairly extraordinary kind of event. Again, benefits of this change: it keeps the plan on the timeline, it avoids that interest rate risk. And as Darren talked about, it supports the revitalization of Midtown, creates that sense of place, and the increase to the city tax revenue, starting in about 2018 to 2019, is about $4 million, and that grows to $7 million when we get out to 2038. So with that, we're back to the summary slide of the three changes.
Okay, thank you, Mike. We'll go right to questions. So first question, let's all look this way. Thank you. All right, the question is, will property taxes in the neighborhoods near the development increase after the mall is open? So I'm not sure, in regards to the your property tax, the mill rates, no, none of your taxes go to pay for the mall, for the mill rate. The other part of the question is probably, will the value of your residences go up? That's a big guess for what happens there. I mean, that's a big guess, but none of the property taxes in the area go to pay for the mall. Now we have a series of questions for Don. So, and Don, you need to go to, or you got a mic there. Use the mic.
Thanks.
So, how many square feet are leased right now? I guess it should be for the totals that leased in new retail.
How many square feet are leased now?
Yes.
New, just
Well,
total?
both, I think. So there's two numbers we always. Can you pull one of those slides up? So I always show that. So there's the total amount of retail that's leased, and then there's new retail referring to retailers that aren't currently in Fort Collins.
Yeah, I don't.
Okay.
I know what the total square feet leased right now. It's about 20%. It's a little over 100,000 square feet of executed leases. I don't know how that breaks down between what's new and existing.
Okay. The other one, another question was similar to that. Of the 195 expected by May, how much is new to Fort Collins?
Again, I'd have to get that information to give you the exact amount.
Okay, that'd be good to get
Yep.
and we can publish. Would a modification work at 195,000 rather than the 155,000 that's proposed in the modified agreement?
I think we want to stay focused on what we're negotiating and not throw out other numbers, 185, 205, 195. I think we want to stay focused
Okay.
on 155.
And the last one dealing with this sort of is the Colorado article of May 14th said you expected 195,000 by the end of May, so what's changed?
Yeah, I think
This is May 14th a year ago.
Yeah. So this is a good good opportunity. That question's a good opportunity, Jerry, to talk about leasing in general, because I think it's important for everybody to understand the complexity of leasing a project of this scale and scope. There's a significant amount of tenants, certainly, that you want in a project like this that are national brands, best-in-class brands, similar tenants that you guys would see in a merchandising mix if you went down to Park Meadows Mall or to Flatiron Crossing. And those tenants allocate capital on an annual basis, like any other business, to invest their capital on a go-forward basis. And as we want to be very pragmatic and very careful on how we put together our merchandising mix, that may involve certain tenants who we really want for the project who are still focused today on 2014 deals around the country. They're still, you might find it hard to believe, but in April of 14 are still negotiating leases and finishing leases and working internally with their teams to deliver stores for holiday of 14. Once that's completed, they'll turn their focus to 2015. So many of the tenants that we've engaged, we have, for example, executed letters of intent with and committee approval, but we're not going to get into lease negotiations until summer or fall of this year, or maybe even some of them into the winter of this upcoming winter, all knowing and appreciating that we're all shooting for a November of 15 opening. It's very common in this business to have that type of dialogue and conversation as we try to put together the best tenant mix for the project. And also, it's important to know that you start with anchor tenants and then you move to what you'd classify as more signature tenants. And that signature tenant may be 2,000 square feet, doesn't have to be 20,000 square feet. And then you move forward from there and put the pieces of the puzzle together. I think there's a lot of very strong leasing momentum. I'd say we have probably upwards of 300,000 square feet right now of engaged tenants. So that would certainly put us very close to the 60% mark, which would be the last threshold. And as we move forward over the next 3 or 4 months, we'll probably add another 100 to 150,000 feet of tenants to the mix, which gets us by this fall actively engaged with 450,000 feet of tenants. To give you perspective, outside of Macy's, if you take Macy's out of the equations as their existing tenant, there's approximately 512,000 square feet of other space within either interior mall space or College Avenue space or the theater, for example, would be in that square footage amount. So it's a little over 500,000 square feet of space to lease, new space to lease.
Okay. Is there something else here?
Sure.
Oh, that was that. All right, lost my cards. All right, got too many cards. Okay, we'll go with this one here. The city and the developer executed an agreement in January. If the proposed amendments are not approved, what happens? Does the developer walk away?
I don't think that we ever try to issue ultimatums or make statements about drawing bright lines of whether we walk away or not. I think we wouldn't be sitting here having this conversation this evening and have the conversations we've had with staff and council prior to this over the past several weeks if we didn't think that a modification to the current agreement was very important. Certainly, I wouldn't be sitting here, and I wouldn't expect you guys to be sitting here if we didn't think this was very important. So it's very, very important that we get this done.
Okay. All right. September 30th, Colorado said 50% retail, 75% restaurant in the pipeline at what was then 711,000 square feet. That's 400,000 K in the pipeline. Why only closed on 90? And why were the retailers excited some months back, but not so much now?
50% restaurant, 75%. Can you just want to give me the card? Maybe I can try to read from it. Sorry.
All right.
Wanna
No,
make
you
sure.
can't see these. These are private.
Make sure I answer it.
And I have to interpret handwriting at times.
Okay,
too.
no problem. Yeah, so I think a lot of this goes back to what I just mentioned about leasing and the dynamics of leasing. And there's significant space in the pipeline, as I just mentioned. And some of that may have been back then some larger tenants that were in play that went away. You're aware of Dave and Buster's. That was about 45,000 square feet, which necessitated the change in the FDP plan. And the last thing is why were retailers excited months ago but not now? I think that's very, very far from the truth. I think the project is being well received across the tenant community from coast to coast. And I like to tell people if you go to Park Meadows and you go to Flatiron and you walk around and you see the relative tenant mix that's in place there, that's the tenant mix you're going to see up here.
Okay. Don, would you stipulate to weekly leasing updates to city officials on leasing progress? And I think it could be some sort of temporal updates.
Yeah, I think we've had a lot of positive dialogue over the last couple of weeks with staff and certain council members with respect to some more regular reporting. We'd already had that conversation and agreed to it in the amendment that was on the table, but I think we further refined that. And I think in the agreement that gets published in the council packets, you'll see some reporting, additional reporting and transparency with council and staff.
Okay, so maybe this is for Mike. What lease up or square footage is required for the bonds to make their payments?
We don't have a real break-even analysis. That's really requires to get deep into Alberta's financial worksheet. We did do a sensitivity analysis about the core model assumed 58% of the space is leased in 2015 and 95% of the space is leased in 2016. So we did a sensitivity saying, what happens if it's 60 in 15, 80% in 16, 90% in 17 and 95% in 18. So a 2-year delay to get to 95% lease out rate. What is the impact to the city on that? Well, that $9 million that we have to put sales tax in grows to $9.4 million. So it's not a real significant impact on the $9 million. The city net new sales tax of 126 that I talked about earlier drops by about $2 million. Because it's all lost there in the first couple of years. After that, we get back on track. So a slowdown on the lease-up rate does not have a significant financial impact on the financial returns to the city or the amount of sales tax that we have to contribute into the deal.
Okay, next question. If the modification isn't approved, do we risk losing current leases? That would be for you or you.
Yeah, again, I think to the extent not approving the modification causes the project to not deliver in the fall holiday of 15, you'll certainly lose leases. So to further expand on that concept, as I said, you've got tenants right now where we have executed LOIs fully approved at real estate committee that we will start negotiating leases on this summer or this fall as they move forward, all geared toward and focused on a holiday of 15 opening. If we go to them and say, hey, we're not going to deliver in holiday of 15, it's going to be summer of 16, holiday of 16, they'll just push back. They'll push their LOI to the corner of their desk and say, we'll revisit that when another year goes by. So there's certainly risk there.
All right.
Sure, hold on a second.
Sure.
When Don mentions LOI, it's a letter of intent. So when he says executed LOI, it's letter of intent. The other thing I want to mention is that, just to sort of echo what Don has said about the lease reviews, that is something that you'll see in the upcoming packet that goes to council, that we are very close to finishing a negotiation related to the city attorney and the city manager getting a much different look at, on a regular basis, the tenant list, the conditions, the status of, and Don and I even talked about that before we came here this evening. So I think you'll see a significant change in the proposed agreement as we come forward into next Tuesday night's meeting.
So Darren or Mike, to start the answer, we had a question which follows on. Can we add an LOI requirement? Again, what is LOI?
Letter of intent. I'm not. What do you? Can we add a LOI requirement?
Yes, that's the question. So there'd be some sort of
Let me try and-
letters coming through, I assume, coming to us that Don received saying.
What's in the current agreement is Alberta will share with us 3 groups of leases.
Okay.
Leases that are executed, leases that have a letter of intent behind them, and leases that are in active negotiation. And Don's going to share that information with us. We said monthly. If it needs to be more than monthly, I think that's probably okay as well. But that's the information that's supposed to start flowing to the city right away.
Okay. The next one is Don. Sorry. You want,
I was just going to say.
you have to talk into a
clarify
mic. Thank you.
I think we should clarify that the agreement requires that these thresholds be executed leases. Is that correct? Not LOIs. So we go one step beyond LOI for each of the milestones.
So executed mean a contract?
Contract has to be signed for a lease that says the space will be delivered on a certain date, and then that retailer will occupy the space on a certain date, correct?
And your name is?
I'm Josh Burks. I'm the director of the Economic Health Office and the scribe for this evening. Hopefully I'm doing okay.
Hopefully you're better at the other job. Okay. Well, so, yeah, no. What happened with Dave and Buster's, Don?
Dave & Buster's opened a store in another small market, what they consider, so I think we take a step back here. Fort Collins in the northern Colorado trade area is considered a small market by national retailers because it's under a million people. So most retailers determine small markets to be under a million people. I don't think clearly that's small. A million people is a lot of people, but in their vernacular, that's considered a small market. Dave & Buster's opened a new store in Boise, Idaho, which they consider to be a small market. I'm a big believer that no two markets are the same, but they opened a store in Boise, Idaho that didn't perform very well, and they pulled back in doing any small market new store expansion.
Okay, thanks. I think with the chart answers this, but Mike can fill it in if it doesn't. Has the total amount of squared feet of lease to companies new to Fort Collins in relation to existing Fort Collins companies changed since the original agreement?
Well, again, the original agreement going all the way back to May of 2013 had 240 of executed, 120 of new. And inside of the agreement, it also said that with the city manager's discretion, we could authorize the bonds between 60 and 120 of new. So that's what's in the original agreement. Now it's fixed at 155 and 90, and it grows to 310 and 150. So in that sense, the threshold is higher for full access to the $53 million in the modification than in the original agreement.
Okay, next one. With the November 2015 expected opening date, how soon will you start planning, promotion, and marketing, Don?
Yeah, so you'll probably summer, late fall. We'll set a hard assuming we get this approved next Tuesday and issue our bonds as planned. We'll start as construction gets further along. We'll set a hard opening date sometime in November, and that'll be a big announcement that we'll actually peg an actual date. It'll probably be somewhere a couple weeks before Thanksgiving. Typically, you want to let the retailers get open and work out any operational issues before the biggest holiday shopping weekend of the year. And then as you progressively get closer, there'll be a lot of outreach with respect to tours that would be open to the community to come tour the mall, hard hat tours. There'll be a website that'll have continual updates on leasing progress and a lot of the things that we've talked about with the town. That information will also be available on the town's website, I imagine. And then as we get closer, there'll be a grand opening celebration and everything that goes around that, and a lot of outreach and publicity associated with that.
Thank you. So, Don, what makes the project exciting? Something that would bring shoppers that they can't find in the other shopping areas. What is unique? Another Staples, Petmark, Walgreens is boring.
We, fortunately, I think for that guest question, we don't have a PetSmart, a Staples, or a Walgreens, or I think any tenants along those lines. I think you'll see tenants here that are certainly unique to northern Colorado, and so I would throw, Loveland, Longmont, Centerra, the project Centerra, anything in Greeley, Cheyenne, Laramie, the whole kind of regional trade area that we draw. A lot of these tenants will be new to the trade area. So that's exciting. I think what's most exciting about this project is, and there's a lot of dialogue or discussion at the previous council meeting about this, about the mall and whether the mall is going to survive. And clearly, we believe the mall is going to survive. But if you look at this project, it's not a 100% commitment to the mall. It's a commitment to very, very unique execution of dedicated interior mall space, about 180,000 square feet of shop space, but also a huge, huge commitment to the outdoor space to take advantage of the incredible climate we have up here for 9 months of the year into the shoulder seasons where you can be outside and you want to be outside, and this is a very active community, and I think it's important that we respect the outdoor shopping environment, and we've created some really unique areas within this project, namely the East Lawn and the West Lawn, and you'll see things here that aren't solely about shopping, bless you, but more about engaging the community, more about the ice skating rink and the art fairs and the 5K runs and the summer concert series in the park and those type of things that are very, very difficult to replicate in a mall. That's why we're not 100% committed to just redoing the mall, redo the food court, and put up some new signage. This is very, very unique to make about a 50% commitment to an interior mall and a 50% commitment to an exterior mall, which I think presents a very unique opportunity for this community to engage with an environment, a shopping environment that's not purely focused on what sign is hanging over a storefront and another store I got to walk in. People are changing and certainly have an expectation that they get delivered an experience, and I think we're going to deliver an experience. Sure.
From my perspective, I think what's exciting and what we get is the removal of blight. I think, as I mentioned earlier, the connection to the MAX system, bus rapid transit system, is very exciting. I think the fact that we will see a brand new Foothills Activity Center, that we're not calling it the Youth Activity Center, but I've seen the designs for that. I've seen the environment that we're trying to create there, and promoting wellness on the side and throughout the community. And then I would add the restaurants and outdoor areas as well. And then for me, as I mentioned early on, this idea of creating a sense of place where a sense of place does not exist in our community right now. That is exciting to me and to my colleagues who have been working on this project.
Okay, thank you. Next question for Darren, and Darren specifically probably. Why does Fort Collins government enter into agreements that are not 100% binding in every respect?
In other words, why is the developer coming forward? Why are we hearing a second and third amendment? What I've learned about a $350 million project, and frankly, what I've learned in my career is that something that looks like a fairly simple deal never is. That whether we're dealing with very complex things like retail marijuana and fracking and city plan and those kinds of things, or a $350 million mall, or bus rapid transit system, which, by the way, you'll hear me say on May 10th at the grand opening that this is the quintessential example of stick-to-itiveness. We've been working on that project for 15 years, and what I've learned is there are no easy answers, that I may think that something ought to take one version, and what I've learned time and time again in Fort Collins in my career is that although these, Don said to me one time, a year and a half or 2 years ago, when someone walks into their favorite retail store, into an activity center, they really have no idea the amount of work that it took to get that favorite retail center in their community. So I would have loved to have had the first unanimous vote on the part of the city council be the final vote. I used the example, I think, to Mike the other day. You know, my iPhone, I don't know, you know, when I download an app, I don't think I've ever seen app version 1.0. What I see is app version 3.6.7 or 3. These very complicated things. In the case of a $350 million development on 77 acres, it is very complicated. There are many moving parts. And Don hasn't talked a lot about it, but there's a lot of things that are working either against or in favor of this kind of agreement. Number one, we have macroeconomic issues at work, certainly as we began this journey 10 years ago, but certainly with Don in the last couple of years. I think that Don can speak to this better than I can, but what I've learned as well is if he's working with a particular retailer who has particular needs, and then that retailer may change their mind at a whim and say, we want to be on this side of the project and we want to have these requirements. Or frankly, if a retailer goes away and there's a new retailer that we're looking at on the site, they may have completely different needs. So I'll finish up. I'd like to say that I would have really liked to have seen version 1.0 stick. We're under construction and we're opening. But it's much, much more complicated than that. Don, do you want to add to that?
I'll add to it. I think it's really a question for us. It really was a question for us, not. So the quick answer is really the agreement is 100% binding. So the point being, if neither party makes a change and is willing to sign the agreement again, the agreement stays. However, the agreement also said if the bonds weren't issued by June 30th, what was the date? June 30th? Then either party can terminate the agreement. So when people say the agreement is binding, it takes two people to sign again. We did that once. There's another modification before the city council, and we can decide whether we do that or not. So anyone who's trying to indicate that the agreement isn't binding, it's not true. It is binding. It's a contract. Thank you, Cindy. We're not going to have any comments from the audience tonight.
It's not an answer. The question has not been answered. It's my question. It's not been answered.
Well, thank you. If we have time later, maybe we'll try to answer it more. So, next question. If Alberta expects to be, this is going with 195,000 square feet by the end of May, and they would get all the 53 million at 240,000 square feet leased, why would Walton not make Walton and make a loan to Alberta for $23 million for the short-term loan, considering they have so much confidence in the project? Probably didn't state that all right, but the meaning you probably got.
Thanks. And it was as a point of, again, overarching clarification, I have a joint venture partnership where Walton and Alberta are partners. So they're not a lender per se. They're the equity partner. I have my own company's equity in the deal along with their equity side by side. So it's not a situation where they would just make a loan. We have approximately $57 million of equity in this deal right now, cash equity, and that continues to go up as we continue to move the project forward. As the construction cycle accelerates, the burn is approximately $10 million a month. So the reason we made the ask is we need to issue the bonds and close our senior financing in order to provide the additional capital beyond our equity that's been committed to finish the project.
Thanks. Okay, for Mike or Darren, the developer has used the word tenuous to describe the current state of the project. How can you describe such a project as low risk or no risk?
As I said earlier, the idea of risk really comes down to which party is at risk. And if I can go back to this slide, the city is not making a financial commitment on these bonds. The Metro District is issuing the bonds. Again, the city could have, and we could have dramatically lowered the interest rate on these bonds, but that debt would have been on the city's balance sheet. And if that startup risk I talked about earlier would have happened and something catastrophic happened and the mall never came out of the ground, the city would have been on the hook for the repayment of those bonds. We made a conscious choice not to support this transaction that way. We made a conscious choice to have the Metro District issue the bonds, and in that sense, the city does not have a financial obligation if there is a shortfall in revenue beyond the sales tax pledge that we've talked about to support the bond payments. So the short answer is if the mall never comes out of the ground and never generates any more than the $3 million a year of base sales tax it's generating now, there is no sales tax increment with which to support the bond payments. And that is the extent of the city's financial risk on the transaction. And that's where I say, from a city perspective, the only thing we're putting into this deal is sales tax increment coming off the deal. If there is no sales tax increment, there's nothing going into the deal. So in that sense, I've used this term before and I'll use it again. The downside to the city is less upside, because we can never go below the $3 million base. Does that make sense?
No, you don't have to ask that.
Sorry.
Okay, question. Can the citizens buy Metro District bonds? If so, how?
I'll give that one a shot, but D.A. Davidson is the investment banker that's working with the Metro District. Typically, the appetite for these kinds of bonds is not the general public. They are hedge funds and other investment organizations that are sophisticated to the point where they're comfortable with the higher risk associated with unrated bonds. Most bonds come out with a rating based on the organization issuing the bonds. We as a city have a AAA credit rating. That's the highest rating you can get from Moody's. And bonds come out typically rated by Moody's or S&P based on the creditworthiness of the organization issuing those bonds. The general public typically is not knowledgeable enough, maybe sophisticated enough, to support the analysis necessary to decide, really, do I want to take that kind of risk or not? So the market for these kinds of bonds is pretty small, it's pretty specific. It's hedge funds and other investment organizations that are familiar with this kind of risk, comfortable evaluating the risk, and comfortable taking the risk. So in that sense, I don't think it's possible for the general public to buy into these bonds. Did I get that right, John?
You need the mic. Okay. And so a follow-up to that is a similar sort of question. If the bonds are too risky for the public, hedge funds, whatever, buy them, how is it safe for the public to use such revenues on such a key project, or to use this mechanism?
Well, it's a well-established mechanism. It's some people prefer to invest their money in CDs. CDs pay pretty low. Other people invest their money totally in the market. There's a significant risk difference between having your money in a CD and having your money in a market. So these are, there are multiple offerings like this over the course of a year across the country. They're unrated, and that's not atypical. So just because they're unrated and they're 7% and they're not marketed to the general public does not make these bonds unattractive to certain kind of investors. It really gets to the risk profile of the investor, and not everybody is comfortable with the level of risk that goes with unrated bonds.
Mike's right. I'll add a little bit of clarification here. These bonds would typically get classified as high-yield municipal bonds. So there's a bond funds, high-yield municipal bond funds that'll bond, Van Kampen, Franklin, PIMCO, names that you guys would know, go around the country and buy these bonds in a high-rated, in a high-yield municipal bond fund, and they'll have other rated bond funds as well. And if you think of it in the context of corporate high yield debt, your Fortune 500 companies, household names that we'd all know, issue corporate high yield debt all the time, and there's a lot of buyers for that high yield debt. It's just how it's priced based on the credit enhancements on this. It's not that it's higher risk to the public or higher risk to the investors. It's just there's not a credit enhancement. We're not using, as Mike said, the city's balance sheet to back these bonds. Then the interest rate would be much lower because the investor would be assured that, I got a AAA credit rated entity standing behind these bonds.
Okay. Another question, if I don't support the project, will I still have to pay taxes that benefit the project? Well, the answer to that is, if you don't shop at the mall, you don't have to pay taxes that go for this project. If you do shop at the mall, you will be helping to pay all those different taxes that were mentioned. What if the mall doesn't attract an exciting key tenant? So what's going to happen?
Well, I think the mall's attracted several key tenants, and we're going to issue a press release probably this summer that includes many of those tenants, and we are very, very confident that the community will embrace and very much appreciate the type of tenants that we're bringing to this community.
Okay. Did delays in Foothills progress contribute to Trader Joe's signing with another Midtown mall?
No, I think Trader Joe's didn't like the taxing structure, the PIF structure, and didn't want to be in a competitive disadvantage against Whole Foods and other grocery stores.
What about some council members' contentions that enclosed malls are passé?
I would strongly disagree with that. I think that, and the data proves it out as well. I mean, I think if you look at the sales of the large mall REITs, so the Simons, the GGPs, the Taubmans, the Macerich, who all have mall portfolios across the United States, their sales are now back past, their portfolio-wide sales are all past 2007 peaks. So if you think of the impact the internet's had on all of our lives with online shopping and the velocity at which that's moved from 2007 to 2014, it's much more prevalent. Online shopping is much more significant in everybody's lives today. And despite all of that, all those malls have moved back past 2007 peaks. And one other story, and from an anecdotal perspective, if you look at the fourth quarter 2013 reporting by all of the retailers, nearly all of them reported sales that didn't meet their targets. And why did they say the sales didn't meet the targets? Because of weather. And unfortunately, that doesn't translate into a direct correlation in sales. The internet's open 24/7. 24/7, 365 days a year, you can go online and shop. And so you would think all those sales would transfer right online, but they didn't, because the American consumer, American public wants to go out and shop. Now, if all you're going to offer them is a dying or dead enclosed mall in the middle of anywhere USA that is going to do a $2 million food court renovation and put on some new tile and hang up some new banners, well, then that's not going to excite anybody, and that's not going to get them shopping in that mall. So I think the mall is far from dead, and I look forward to this redevelopment of Foothills proving that wrong.
Darren, what is the historical precedent of a city bailing out a metro district after a bond default?
I'm not probably the only person that has this context in the room, and Jerry, you may have some as well. But metro districts have had a bad history in the 80s, I think the early or throughout the 80s, as it related to residential developments. Much better track record, and Don can speak to this, as it relates to commercial properties. Jerry, could you repeat the question?
What is the historical precedent of a city bailing out a metro district after a bond default?
Yeah, I think that primarily has been in the residential category. Don, do you have context for that? I can tell you in Fort Collins there's been zero precedent. Fort Collins has not had a commercial metro district fail. In fact, we have one existing metro district that has not been activated, and that's on, I don't believe it has been, that's on the Harmony Corridor across from Hewlett Packard, just to the east of Intel. And as far as I understand, or as far as I know, we don't have any other metro districts in Fort Collins relating to commercial
And there was
property.
a related question: what other metro districts have been done in Fort Collins? So
Yeah, one that is inactive at this point. This
do
would
we
be
have
the
any
second.
other urban renewal bonds?
Do you want to speak to that?
In the North College area of Fort Collins, when that project got started, the city loaned money to the Urban Renewal Authority driving North College. that number got up to about $16 million of loans. Just in 2013, we took 11 of that and we refinanced it with an outside entity and paid the city back. So the URA in North College does have $11 million of outstanding bonds associated with North College.
Okay. The development includes plans for housing. Some agreement was included regarding affordable housing. Can the city talk about how this will apply to the development? And then we'll have comments from Don on this too.
Yeah, the agreement doesn't specify units of affordable housing. The agreement specifies if City Council passes an affordable housing fee, and I can't remember if it's December 1st or December 15th of 2014, the developer will retroactively pay that fee. So staff is in motion as we speak, working through what would be an appropriate affordable housing fee, as long as that is implemented prior to sometime in December of 2014. That's what's included in the agreement, the payment on that fee.
And that will be a city council policy discussion, debate. If this council puts that in, if the development agreement is approved, and if city council approves that, then Alberta has agreed in this contract that they would pay for that. But that is a conversation, a public policy conversation the city council will have before the end of the fourth quarter. Don, do you want to add?
No, okay. Next one. If the underpass under College Avenue, the pedestrian bike underpass, and the youth activity center are non-blight remediation prospects, how can they be financed by the URA? So how can we finance the two public improvements associated with this?
Sure. Josh Burks, Economic Health Director again. So the question is, if they're not blight related, how can they be funded by urban renewal? It's my understanding that the urban renewal law allows for a variety of different improvements to be created, and they're financed under that aspect of the law. In essence, public infrastructure that's required in order to make to comply with city code. So the underpass speaks to pedestrian connectivity and so forth are eligible, and then the fact that the existing facility is being deconstructed and being replaced, I also think therefore makes the activity center eligible as well.
Okay, thank you.
So certainly plenty of lawyers have reviewed it, and that's consistent with statute. So.
If investing in mall development is deemed a good investment, why is there not enough private money to get it done? I think we ought to answer too after Don does. Yes.
Sure. I think we've been consistent since day one, since I very first sat down with Darren before we acquired the mall, that this needed to be a public-private partnership, and but for that, the case was pretty clear. The mall wouldn't be redeveloped. So I don't think there's been, again, as I said from day one, any disconnect. Darren can speak to this as well on the need for the public finance component on a project of this nature.
Yeah, let me just affirm that the very first day that Don and I talked, that was something that he said in order to make this, to remove the blight, to have a redevelopment at the level that the city of Fort Collins has been saying for years that we want, it's going to take a public-private partnership to do that. I think if you go back and look at some of the conversations that we had with general growth properties as well, those numbers, public investment we were talking about, were in the $20 to $40 million range as well. So this is not the first project to seek a public-private partnership, and I very much believe that this project, we would not see this project. Matter of fact, I can speak with great certainty that without a public investment, this project would not be occurring, and that all the amenities that we've heard through many public forums and conversations about the sense of place that folks want here in Fort Collins, that would simply not occur. And you'll recall that even with the Bayer property at Front Range Village over on Harmony and Ziegler, there was a public-private partnership there as well. So if you walk down the main street in Front Range Village, and all the pedestrian amenities and the various elements that make a good urban space, I can tell you, and my colleagues in the room will verify that those would not have happened without the public investment at that site as well.
Okay, and we touched with this a little bit, but maybe a little more, Don. So are national market conditions poor for mall redevelopment right now? Since we know, this just adding for what we've heard, there's only 4 or so malls being done, some small number.
I don't think they're poor. I think they need to be in the right communities with the right support and the right overall dynamics. I think what you have in a lot of communities, typically even in the size of a community of Fort Collins or Northern Colorado, is you'd see 2 or 3 enclosed malls that got built, in the 70s and 80s, and it's very difficult at that time to have the tenants choose. They have a lot of relationships with the different REIT owners, and I don't think by any stretch of the imagination is it again difficult in the context of are tenants less interested? If that's maybe the question, are tenants less interested in mall redevelopments? No, I think they want to see good properties and good markets redeveloped.
Okay, so we've sort of answered this before, but I think it's an important one. So what happens if this mall fails? Who will pay?
Yeah, I think we have kind of answered this one. Again, the Metro District is financially obligated on the bonds.
Which is the property owners
which
of
is
the site.
Which is the property owners, Alberta and Walton, and Macy's. The construction financing is totally on Alberta and Walton. So if the mall, and I'll talk failures in 2 ways. One, the mall never comes out of the ground. That's entirely on Alberta and the Metro District and the property owners. 2 is the mall comes out of the ground and it simply doesn't perform. What happens if it doesn't perform is, again, Alberta's and the Metro District are still on the hook for those bond payments. The city, instead of generating that $117 million of net new sales tax revenue, would generate something less on a lower performing mall. We would still most likely generate more than the $3 million we're getting today, but where it ended up in that spectrum is really difficult to say with any certainty.
Okay, so what happens, what if the project continues to be delayed and downsized? You guys all looking at each other.
No, we're
No,
just
just-
thinking who's going first.
Okay.
I don't like to play the what if game, and I'm hopeful that next Tuesday brings the right outcome to let the current plan go forward. If it doesn't get approved and we have to revisit the entire plan, we have to basically start over.
Okay, why do we care about the 2015 open, given increased startup risk from going from 155 square feet being leased to where it would be 240 if we waited? And the answer is, I understand the question. I understand why the developer cares, but why do we care as a city?
Well, as Don just said, if we delay 2015, I don't know what comes next. I don't know if it's 2016, I don't know if it's 2017, I don't know if it's 2018. I don't know what the deal looks like without this modification. So I guess from my financial perspective, why I care as a city staff is I do see this as an appropriate deal and a good deal for the city. It generates incremental new revenue for the city. And I think it would be unfortunate if we lost the opportunity for that incremental new revenue. I'm not saying it would happen, but if the mall ended up with a chain link fence around it in the middle of Fort Collins, one thing the city would lose right now is the $3 million a year of sales tax revenue that has been coming off the mall. That would go away. That would be a loss of an existing revenue stream because the mall project got mothballed.
I would worry that we would lose momentum. I would worry that we would lose retailers that have already signed up, that with a year delay, that they would say we're gonna focus our attention in other areas, and these are retailers that are retailers that attract other retailers. So I And as Mike has said, I don't know what that next version looks like. And that uncertainty makes me very nervous after 10 years of working on this project.
Okay. From the developers and city's perspective, why is the performance-based metrics for release of the bond funds better than the current agreement that we have? And how common is this approach? You start.
I'll defer to Don on how common this approach is, but I believe the laddered or the tiered approach is better for the city because it raises the threshold of leases that have to be executed before all of the 53 million is made available to the developer. It was 240, it grows to 310. Net tenants new to Fort Collins moves from 120 to 150. That's a higher standard for full access to the $53 million than what's in the existing agreement. And it allows it to stay on the timeline.
I think we've done north of $250, $300 million of public finance, and I don't think we've had a tighter set of covenants with any city that we've ever done business with. And so I think that clearly this city's done an incredible job, at least in my experience, of creating a structure that is much tighter, and as Mike just mentioned, presents this new ask also presents an opportunity for the city to gain further confidence that the bond proceeds will be pushed out further than they are right now at the current structure. So, again, in my experience, I haven't seen an agreement that's been this tightly put together.
At how many square feet will the mall be profitable?
At how many square feet leased?
Yes.
Probably around 85%.
Okay. And this will be for Mike and Darren. How do the benchmarks compare to revives? The 30%, 6%. Will these benchmarks make the mall profitable?
I'm not
Compared to the
sure.
Revive project that had certain benchmarks.
The Revive project up on
Yeah.
North College?
Yeah.
I think I'd like to think
Okay.
about that question. I'd have to go look at the Revive project in more detail.
To be announced later. What is the financial difficulty to the city under the current new 4.3 wording? So why don't you get the 4.3 wording up there? That's one of the changes. That's one of the three changes. And then the rest of it, let's hold on to this insurance and let a future council give it back if they perform.
Yeah, I'm going to approach this one a little directly because
So why don't you first say what it is, though, what the section is?
Yeah, the change in the wording really is clarifying that if the event of the developer misses the delivery dates on the residential units, 200 in 2016 and 246 in 2018, starting in 2020, they will start to pay to the city 50% of the lost property tax increment that was anticipated to come from those units. That's the current deal. Again, it's read by the attorneys as if they miss that date and they start paying the 50% and then they build those units and they start paying the property tax, they have to pay both. The clarification is just that you pay one or the other. If you miss the date, you pay the 50% until you build the units and the property tax starts to flow, and then you quit paying the 50% because you're paying the property tax. The reason I don't think it's appropriate to hold on to this thing is it was never our intent to create a situation where the developer is in a penalty mode in perpetuity if he misses the original date. That was not our intent. And I believe when you're negotiating in good faith with another business entity, your intent matters. And if something unexpected happens, and that was never your intent, to try and take that in your favor will work against you in the long term, because eventually something's going to happen that's not in your favor. And you're going to go to your partner in that deal and you're going to say, that really wasn't our intent. We need to modify that. So I just think in good ethics, good fairness, the dialogue we had in that discussion was not to create a 50% penalty for the life of the Metro District. That just wasn't our intent. So I just, from an ethical business practice, I don't think that's appropriate.
Okay, this one's for you, Don, the developer. Where else has the developer done these kinds of projects?
These kinds of projects, these are very unique projects. We took a project down in Denver at University and Arapahoe was formerly called the South Glen Mall. It's now called the Streets at South Glen, which had 4 department store anchors, and retained 2 of those, and now has a Whole Foods, a movie theater, a library, a gym, apartments, office buildings, and so on and so forth. We did the largest single retail project in the state of Colorado, 1,700,000 square feet, ground up at Southlands at Smoky Hill and 470, and we're currently repositioning a mall in Los Angeles.
Okay. Could we get a lower bond rate if we continue to put 25 or 50% of the incremental sales into the supplemental reserve until we can pay off early?
Yeah, I don't know that the bond interest rate would change if we made a different commitment on the sales tax. What would cause the bond interest rate to change is one of 2 things. Either the city issued the bonds, and the city leveraged our current balance sheet and our AAA credit rating, and if we did that, we could probably get a 3.5% interest rate on those bonds. But again, then that debt would sit on the city's balance sheet, and if these risks we're talking about were to happen, the city would be obligated to repay that. Second alternative to lower the interest rate on these bonds was for the city to give a moral obligation pledge to the Metro District, saying that if the Metro District is unable to meet the payments on these bonds, the city will step in and make those payments. That would cause those bonds to be rated because it's got the guarantee of the city behind it, and that interest rate would drop dramatically. Same issue would happen, though, if there was a problem with the Metro District and they didn't have the revenue to pay the debt on those bonds. The city would now be legally obligated with which to make those payments. An example I'll give you, it's a suburb of Chicago, and they did a moral obligation with a developer on a hotel and a convention complex, and the deal didn't materialize in the right way. They gave a moral obligation on that pledge. They got a really good rate. I can't remember if it was AA or single A on the bond issue, but when that deal went south, that particular city elected not to honor their moral obligation pledge. Their rating from the credit agencies dropped 6 ranks because of their unwillingness to honor the pledge that they gave to that particular deal. So those were 2 alternatives we looked really hard at 15 months ago before we made the decision to have the bonds issued through the Metro District and to pledge our sales tax and to create the supplemental reserve in order to provide credit enhancement for that bond deal.
You know, I want to go back to the question that was asked about what's the downside of maybe delaying the project. I think Mike has spoken to this as well, and that is you probably ought to know that, and correct me if I'm wrong, Mike, but a 1% swing in interest rate on this project is about a $17 million impact. So delaying a project for 1 season, 1 year, really, I think, adds significant risk to the bottom line of the project as well. It could go down, but it could go up as well. And so, you know, we've all been watching interest rates very closely, but in a project of this magnitude and the kind of money that Alberta is talking about in terms of their project, interest rate variation is a major risk.
Okay, isn't it better for the city to have the mall fail when we can take it under eminent domain instead of when the court will be looking out for bond investors?
Did you say, isn't it better?
Yes.
I said, I would say absolutely not. It is not better for us to take a project under the auspices of eminent domain. I think that is, no, I don't support that at all. Mike, do you want to give a more reasoned response?
Next. Okay. As of today, what % of the mall's surrounding property is leased?
I'm not sure I understand. Do you understand the question? In Midtown? What percentage
Yeah,
of
the Midtown, I assume in the areas around the mall.
So are they asking about vacancy
So do we
rates
have a lot
maybe?
of vacancies, or how's that looking?
Josh, can you answer that?
I don't know that I can speak to like immediately adjacent to the mall. I do know that Citywide, I think our retail vacancy rate is between 7 and 8%, if I'm remembering the data correctly, across the whole city. We do know that a large concentration of that retail space is along Midtown. Therefore, I think it would be reasonable to assume that that's probably about the right amount of vacancy in Midtown. There are a few properties that I think in Midtown that have been vacant for a long period of time. I think we all know them, the former Steels / Alfalfa / now owned by Whole Foods and Toys R Us. But we've seen some movement on those properties recently.
Okay.
So,
Josh, is that something that you can provide some context for?
yeah, I certainly can follow up with some better data on exactly what
And
the
I think
figures are.
it was surrounding, not just right adjacent to, but in that area of Midtown. Okay, next question. To reduce the risk, why not do this? Extend bond deadline to 12/31, 10 equal benchmarks, 8 from the 240, 195 to 500, and 2 from 500 to 564 for square feet leased. Since we're already paying $70 million of interest for unrated, okay to have 17 million less upside to prevent startup risk. And I might not have got it all right.
There
but
was
you-
a lot in that question, so I'm not sure I can get it all.
Okay, so the idea is extend the bonds not being issued to 12/31, have 10 benchmarks, forget what that, but 10 benchmarks from wherever, some lower number to a higher number, and that way you prevent a whole lot of interest from happening.
Well, the concern I would have with pushing the bond issuance back to
Right.
December gets to the interest rate risk we've already talked about. I think it just works against that. I as well would say, to me, the question we're wrestling with is there greater risks to the city or the Metro District issuing the bonds at 155 versus 240? And to me, we look out objectively and we say, what's going on with the demographics of Fort Collins? We're growing. We're a hotspot in the nation for growth. Our demographics are good. Our population is young. It's educated. Our wealth per family is on the higher side of the national average. This is a growth place. I'm not seeing evidence that says the leasing strategy is seriously at risk at 155 versus 240. If I were, I think I might land on a different opinion about what the risk of this variation is. But there's nothing that I've seen or any conversation I've had that really indicates the risk changes substantially issuing the bonds at 155 versus 240 with the phased release that we've structured into the deal.
Okay, so we have some questions dealing with our ability to use certain funds for URAs and bonds. The Colorado Supreme Court has opined that the revenues that would otherwise not be available may be obligated to pay a URA's own bonds. How can the city obligate monies that would otherwise be available, i.e. transferable sales tax?
Yeah, and I'm going to take a layman's approach to that. There have been a number of attorneys, both the city attorney, Steve Roy, the deputy city attorney, Kerry Daggett, external attorneys at Sherman and Howard, a couple of other law firms, attorneys at D.A. Davidson, the bond attorneys who are reviewing these documents. And I don't profess to be an expert in state statutes and how these kinds of regulations work. This is where, as a chief financial officer, I have to rely on the legal expertise of people who play in this particular place. All those people have looked at this transaction and have not had any reservations from any of those legal resources who've taken a look. There is no indication that there's any problem with the way this deal is structured and the way we're planning on going to market. And that's based on the legal review of those folks.
Okay, a similar question. If Fort Collins is not obligated, is not obligated to use the KFCG, the natural areas, the Bob tax, the BCC sales taxes, because these taxes are dedicated, approved by Tabor elections. Why is the URA obligating revenues from the Poudre River Library District, the 2010 PSD levy, the 2010 PSD bond repayment levy, the 1999 PSD mill levy ordinance, etc., which are all dedicated, approved by Tabor elections?
And the best I can say is, again, ditto to the last answer. There is tax increment financing statutes that govern this. Legal folks have looked at it, and we're, I think, operating 100% inside of those statutes and how these kinds of deals are supposed to come together.
Can the city make multiple-year financial obligations without a vote? Why does Mike Beckstead continue to assert that such a scenario is possible? The city isn't taking the risk because it can't due to Tabor and city charter? Mention you. Yeah.
Can you repeat the question?
Can the city make multiple year financial obligations without a vote?
The answer to that is no.
Why does Mike Beckstead continue to assert that such a scenario is possible?
I don't believe that's what we're doing.
Okay? The city isn't taking the risk because it can't. I guess that would be a statement. According to Tabor and city charter, obviously we think differently.
Yeah, and I think the distinction here is, again, the tax increment is not the city's. The tax increment is the URA's. And there is a distinction in those statutes between what a URA can do and what a city can do. And again, I'll go back to the legal review and the legal advice we've had in this thing. We are operating 100% in line with the statutes and the regulations. And
Okay?
But if it fails, the
No.
city has to bail the
No,
bond, is that
no.
correct?
Yeah. Go ahead. You can answer the question, what happens if it fails? We've answered it a few times, but you can
yeah,
answer
we
it
have.
again.
Let me try it one more time. No, if the Metro District fails and the Metro District doesn't have enough revenue to meet their bonds, and there is no tax increment from the city is under no financial legal obligation to bail out the Metro District on these bonds. Our only obligation is the pledged sales tax increment that comes off the mall, and such that if there is no pledged sales tax increment because the mall never got started, that's the only obligation the city has to support these bonds.
Okay. Don, what is the final square footage of the new mall? And what about the surrounding proposed buildings?
I don't know about any surrounding proposed buildings in the entire project.
Yeah, the entire project.
Not including Macy's, it's 512,000. I believe Macy's is about 127,000 square feet, the existing box.
And does the square foot requirement mean only the mall proper or all the other new construction, less residential? So the footprint includes it all in the footprint, correct?
Yeah, it includes it all except for
Can you get
Macy's.
that slide up, Mike? There's a picture of the mall, so then maybe you could just point
Yep.
to it or show what we're talking about.
So here's the Macy's box, which you're familiar with, that exists. Again, that's about 127,000 feet. The balance of the project, including all of the shops along College Avenue, the new interior mall, the new west lawn, the east lawn, not including any of the multifamily, but all the commercial space is approximately 512,000 square feet, and that's the number that these square footages and percentages are based off of.
Okay. When do you expect to have the 240,000 square foot leased? If the amendment fails, what size bridge loan would you need to stay on schedule? If we extend the bond square footage deadline, how else could we fund the bridge loan without bonds? You can take a look at it.
I guess, we would expect to hit the 240,000 sometime early fall. If the amendment fails, what size bridge loan would you need to stay on schedule? Again, we haven't, got into a detailed analysis of that. If we extend the bond draft deadline, how else could we fund the bridge loan without bonds? The bonds are only a part of the capital stack, so the bonds make up a portion and they have to be allocated for certain public improvements. Along with the bonds closing, a $145 million senior loan facility also closes, and that facility provides a lot of the financing for the project. So we have equity, developer equity, we have new senior loan construction financing, and we have the bond financing. In the totality, that provides the total capital to build the project.
Okay, our final three questions in our Jeopardy round, and I'll take these. If the mayor has not voted due to a conflict of interest thus far, why is the mayor now going to be the tiebreaker? Well, the mayor hasn't said she's going to vote, so she's not the tiebreaker yet. Did she move? No, she has not moved. She's still where she has been located since she moved from North College after they sold the motel. Does the mayor have a conflict? Well, the mayor has a conflict. The Ethics Review Board said they thought she did. The council agreed with that. Will she remain recused or join in? That's up to her. Both the Ethics Review Board and the council are recommendations. They're advisory to the mayor. Any individual council member can choose what they would like to do. with all this additional information as a city council member, why wouldn't I vote yes on May 6th? I'd suggest go to the meeting May 6th and see what everybody has to say. And with that, we're closed, and I want to first thank everyone in the audience for coming, asking the questions, and being so respectful of others in the audience. And I thank our Mike Beckstead and Darren Atterbury and Don Provost and our excellent recorder, Josh Burks, as well as the city folks who helped organize the meeting tonight. So thanks everyone for coming, and we'll be around to answer some more questions.
Thank you.